morning, good afternoon. It's Shatori, your favorite realtor with Attraction Realty, where I'm attracting you to your next home. So I'm coming live to you today for Talk to Me Tuesdays, where I come live every Tuesday at noon to discuss all things related to real estate. So let's talk. Today's topic is how much money do you need to purchase? I figured this would be the perfect topic today. I've had this question maybe about 4 times already today that I had to answer. And so right now, I'm also noticing that my timeline is flooded with everybody so excited about receiving their stimulus checks. And to be honest, I really haven't kept too much up with it. And I'm also hearing talks about working mothers being able to get monthly checks this summer. And then on top of everyone getting their stimulus checks, then you're also getting your tax refund checks. It's that time of year. So you have all these different sources of income that's coming through right now. But the biggest question is, how do you plan on spending your money? Okay, because I truly hope that those that can invest their money to please do so wisely and find a way to make money off of this money that you're about to get. And those that have plans to purchase, I hope you put these funds into a savings account so you can use towards the purchase of your home and don't touch it until you're ready to purchase. So how much does it cost to purchase a house? Right now, the average price range for a house in today's market is in the 300 range. There are still some in the 200 range depending on the areas that you want to be in. And so let's just say you qualify for a $250,000 house. And the typical down payment to finance is anywhere from 3 to 3.5%. Sometimes it can be 5%, but on average, 3 to 3.5%. So 3.5%, we'll just use that as an example. So 3.5% down on a $250,000 house is about $8,750. So you would need at least that to get pre-approved to purchase a home for $250,000. Next, you have to think about closing costs. So we average closing costs to be about 3% of the purchase price. So that's another $7,500 in closing costs for a $250,000 house. So to purchase a $250,000 house, you will need about $16,000 saved. So of course, the higher the house, the more money you need saved. So where do these funds come from? The number one way is, what have you saved? So if you haven't already started saving now, will be a good time to put together a monthly budget and figure out how much you can save each month. You get these stimulus checks, you get your tax refunds, all that can go a long way with helping you save in addition to how much money you're taking out of your paychecks each week. Secondly, you're able to cash out of your 401ks, IRAs, or any other investment accounts that you have. I do strongly urge you to contact whoever is holding your 401k or your IRA and understand the max amount that you can withdraw to purchase. And sometimes they will disperse these funds before you get under contract. Sometimes they'll wait until after you're under contract and then they'll request documentations for the closing in order to disperse funds. So it's important to know that as well when speaking to your investment companies. But you can also have these funds gifted from a family member. So a family member being a grandparent, a parent, a sibling, or a spouse or a child. So if they gift you the funds, they will need to be able to prove where these funds came from for the lender to consider it. So the lenders are going to look at the last 2 months of their bank statements to see where this money came from. If it was already sitting there, or if it came from some source of income, they're going to want to know how did they get the money in order for you to use it. Lastly, sellers can contribute to your closing costs. So last year, I was able to get the sellers to pay pretty much all or half of your closing costs. In today's market, sellers are not willing to give you money to purchase their house when they have a tremendous amount of buyers that are not asking for any money. So I always tell people just be prepared to have your own money versus us asking the seller. If we can ask the seller, then so be it, but be prepared. So now if you look into new construction, most sellers with new construction will give you about $7,500 towards closing cost incentives on average if you use their lenders. So those are 4 different options of how you can get the money needed for your down payment and closing costs. If you watched last week's episode, I had a special guest, Mr. Eli Jor with Cross Country Mortgage. He's a loan officer, and he did advise that, any pocket money or mattress money, whatever you want to call it, that you want to use towards purchasing this house, it must be in your bank account in season for at least 3 months before you start the process. So that's just a big tip that I can't stress enough. So for those of you that didn't know, it does cost money to purchase a house. And even though you're financing, there's still out-of-pocket expenses. So let's talk about prepays. I talked about your down payment and closing costs, but there's something called prepays. So with prepays, there's 3 different prepays that I can go over. So once you get on the contract, you pay what's called earnest money. Your earnest money is your good faith estimate that lets the sellers know that you're serious about purchasing their home and that you're willing to put a minimum of 1% down of the purchase price for them to take the house off the market and hold it for you until you can get the proper funding to purchase it. So this is not, this does get credited towards the closing of your home, and there's only 2 ways to get a refund of your earnest money if the deal does not work out. So one is if you terminate during your due diligence period, and 2, if you terminate, if the lenders terminate you because you're not able to get your financing. So if they deny you for the full approval of the loan during your financing contingency, that's the second way that you can get your earnest money back. Number 2 is the second prepaid that you have to think about is a home inspection. I highly recommend that you get the home inspected. I would never advise you to purchase a house without properly getting it inspected by a professional. So inspectors normally range anywhere from $300 to $500, depending on the square footage of the home. But that money is paid to the inspectors directly and is non-refundable if the deal does not go through. The third prepaid that you want to think about is the home does have to be appraised. Most appraisal fees are around $500 to $700, and it is also non-refundable if you do not close on the home. Now, depending on the situation, sometimes those funds can be, if it's the same house that you're closing on, but you have to go through a different way of getting financed. Sometimes the appraisal can be transferred to the new loan program that you're going under, and sometimes it can't. So that's some situations, I've had that situation to happen before, where I was stuck in the middle of one transaction and we were going conventional, but we had to switch over FHA, and sometimes you can't switch over the appraisal. Sometimes you can. It depends on what the lenders and the appraisals can work out. But typically, if you're not able to close on that home, that fee is non-refundable. So you want to think about those 3 prepays up front. Those are your upfront out-of-pocket expenses, but your down payment and your closing costs are paid towards the closing of the transaction, and that's usually typically 3 days before you close. But you can't get your full approval to close without the funds being in your account ahead of time. Now, what are closing costs? So just to go deeper into what you're paying for, I told you before, closing costs is on average 3%. So it varies for each house because there's so many different variables into it. So you have the county, city, government fees, and then you have all your lender fees, you have your title fees, taxes, insurance, and if it's in an HOA community. So this just gives you an idea. So what you want to do is determine your price range for the purchase price of the home that you have in mind, and you multiply that to about 6% estimated, and that tells you about what you need to be able to purchase the house. So if you want to purchase a $300,000 house, you take 6% of $300,000. If you want a $400,000 house or a $200,000 house, you just take all that into consideration and add that up to see how much you need in your savings account. So that is all that I have for Talk to Me Tuesday. But I will definitely be back live tomorrow for Hump Day House Hunt. I received several requests to show homes in the $200,000 price range. And I also got requests for the city of South Fulton and Lithonia. So tomorrow I will preview new construction homes in the Fairburn area. And Friday I'll post for the Price is Right for homes featured in the Lithonia area. So that's my time for today. Thank you guys for tuning in. And if you have any questions, feel free to give me a call back at any time. And I look forward to working with you.